Thank you for joining us today. I'm joined by my business partner, Drew Heatley. My name is Alan Green. We thought we'd give you a little look at expectations heading into 2026 and then recap the first half of the year. Drew, maybe you can just start off and talk about what those expectations were and what we've actually seen.
Certainly. The expectations heading into the first quarter were really a continuation of the trends that we saw in the fourth. Notably, this would be a decline in interest rates and an expectation for Fed cuts in 2026. Also, we started to see dwindling of inflation pressures and more of a normalization back to hopefully the Fed target of around 2%. We also were expecting pretty strong corporate earnings. What we have experienced has been a mix of those expectations. We've actually seen an increase of interest rate expectations based on the conflict in Iran. We've also seen a resulting increase in inflation, again, as a result of Iran. And importantly, we've seen an increase even in corporate earnings expectations and what they're delivering above and beyond what were already strong expectations.
That's interesting. Maybe talk a little bit about the strength of the consumer and what we've seen so far.
Absolutely. The consumer is still very strong in aggregate, although I will say if you were to kind of nitpick, there is some weakness in the lower 60 to 80% of income earners, and the economy's spending is really being supported by that top 20%. Now, this is really a side effect of the inflation we've had over the last 5 years. I'm sure you've heard the buzzword, and we've brought it up before, the K-shaped economy, but really it's a story of the have and the have-nots, and those upper 20% of earners, they have real estate, they have stocks, they have savings that could have benefited from the inflation or inflation policy over the last couple of years, and they're the ones with the excess to spend. It seems like lately, over the last couple of years, in the first or second quarter, that we're kind of getting a geopolitical event that throws everyone a big curveball. Notably, we've had the war in Iran. What else and how has that been affecting things?
We had Venezuela before that, and as you know, our crystal ball is cracked and foggy, and one of the things that we prepare for without knowing when they're going to occur is geopolitical events.
Sure.
So the geopolitical events at hand have obviously led to higher oil prices. The U.S. is a net exporter of energy. This has been good for energy earnings, but it hasn't been good for particularly low-end consumers or inflation. I think those are challenges that we'll have to keep an eye on going forward in the second half of the year.
Great. And as it relates to other kind of side effects of all the spending that's going on with the government in these wars, how are those aspects looking?
Yeah, in fixed income world, you really need to be aware that we are running continual deficits, which are leading to greater debt. And we take the strategy that you want to have ladders in your portfolio so you can earn income without putting yourself at too much harm's risk. We also diversify that in different areas. But I think that's one thing that clients have to be aware of. After 40 years of declining interest rates and lower inflation, that cycle seems to have been broken during COVID in 2022.
Yeah, it seems that way, and no signs to point to anything changing.
Right. And the demand for energy, forget the war for a minute, is massive. These artificial intelligence companies need computing power. In order to generate that power, they need to have data centers. Those data centers, as you might have read, take a tremendous amount of energy, but they also take clean water. And there's this whole strategy of not in my backyard, or NIMBY, you may have heard of, where local residents don't want a data center as their neighbor. So despite all these issues that I just mentioned, Drew, the market's had a lot of success in the first half of the year. I think most people are surprised, particularly with some of the equity performance. What has led to that?
Yeah. With any conflict, once it kind of pops off, if you will, there's always uncertainty. And so the market was not going to necessarily avoid that completely, but in short order, it recovered because the story got back to what really drives the market, and that's earnings. So really, when you reflect over the last couple years and then where we are today at the midway point in 2026, it has been the earnings story that has been driving the markets and what really the market can rest its hat on. You mentioned AI related data centers and kind of that infrastructure, and that's probably the biggest component to the earnings growth story that we can point to, because the top 5 hyperscalers, and these are going to be Google and Facebook and Oracle, those kind of companies, they're investing approaching 600, 700, almost $1 trillion expected over the next couple of years in capital expenditure into these areas. All of those dollars then get flooded to all of the ecosystem in AI. Everyone from the chip makers to the cabling manufacturers to the folks who dig the holes that you put the data center in. And that is leading to huge earnings growth numbers. It's estimated about 24% earnings growth year over year. You don't usually see those numbers outside of recovery from recession, but that's happening right now in the couple of years later in a bull market.
Aside from earnings, the other impressive factor has been it appears that the IPO window is open.
Absolutely.
Care to comment on SpaceX?
Well, who? Yeah, so at the end of the day, I think SpaceX was the first IPO that we've had in quite some time that generated a lot of sentiment and enthusiasm. We've been seeing it coming for a long way, and through the end of the year, there might be a couple other kind of premium or premier IPOs to come with some of the private AI names that we all know.
Anthropic, OpenAI.
Exactly, and again, these are stories that have been told for a while, and we're kind of getting to one of those closing chapters on the private side where these companies actually go public.
Yeah, it's an exciting time. I happened to be at Morgan Stanley right before the SpaceX IPO, and it's hard to measure the scale of a private company coming out at $1.75 or $1.8 trillion.
Huge numbers.
How about client awareness for the second half of the year? What blocking and tackling steps should we be aware of? Is there any new rules that came out?
Well, really, just in the last couple days, what's been on everyone's mind in the chatter and in the investment community has been around Trump accounts. Now, maybe I'd actually turn it to you to say, hey,
sure,
what is a Trump account and how can we take advantage?
Trump accounts are really designed for younger individuals who may not have the earned income requirement to fund an IRA or a Roth IRA. So for young children born in the second term of the Trump administration, there's actually a $1,000 benefit for opening these accounts. But in addition to that, employers and parents, or even relatives, can fund them up to $5,000 per year until the child turns 18. These are definitely an advantage, especially for those folks who have already maxed out their deductions for 529s. They've already done the Roth IRAs personally, and they want to give something back to their children. But I also think that they're going to have a big impact, particularly for those children receiving the $1,000, to make more of a mark where you have participation in the asset growth that we've seen over the past 10 or 15 years.
Yeah, I would say this is one of the biggest evolutions in access to retirement savings that we've had in quite some time. So yeah, pretty remarkable.
It's impressive too that the Dells and others have made these massive contributions, essentially trying to give young children a head start on their retirements.
Now, one thing that's also on the horizon are midterm elections. Yes. Anything special to say about midterms and their effect on sentiment or portfolios or the markets?
Yeah, you know, Drew, that we don't react a lot to political. I find that half of our clients lean one way, the other half lean the other way. And if we changed course every time the midterms changed, whether it's the House, the Senate, the presidency, we'd be flip-flopping portfolios and often missing out on long-term trends. Obviously, this has been a long-term trend up. I would call it from the start of 2009 till now. We've seen different administrations, and in every administration since then, the market has gone up. So we prepare for the volatility around a midterm by using things like alternatives, by diversifying with stocks, bonds, and alternatives. But we're probably not likely to make large-scale changes just because there's an upcoming election.
So if we're going to head into the back half of the calendar for 2026, any best practices that we're implementing for clients or that anyone watching or listening should kind of keep in mind for themselves?
Yeah, I think one of the things that we've been really focused on, and it seems like the industry has caught on to this topic, is being tax aware and tax efficient, and making sure that we're communicating with our clients' CPAs and keeping their taxes as low as humanly possible. It's part of the reason why we added a dedicated financial planner, so that we can liaise with those other centers of influence to help out clients get the best outcome. Trump accounts would kind of fall into that.
Certainly.
Roth IRAs, mega backdoor Roth. There's lots of different strategies. What I would say is that we're not Susie Orman, so we like to meet with clients individually and talk about their specifics. But our detailed process, we call it PIMIA, helps us not to leave any stones unturned.
Absolutely. That's great. Well, for those of you watching, thank you for joining us and spending a few minutes with us. We're excited to see what the second half of the year brings. Any questions on what you've heard or any questions in general about our practice, please reach out. We look forward to the next time we get to see you and to chat. Thank you so much.
Have a great summer.